Welcome to Catalyst. I'm Madison Mills. We are 30 minutes into your trading day. Let's get you the three catalysts we're watching this hour. First up, has the market found its bottom? That is the question we'll pose to a slew of fund managers this hour. We'll get you their answers. Plus, a read on the health of the consumer as Dollar General results offer the latest sign of a potential slowdown. And the IEA warning on the demand outlook for oil as the trade war threatens to disrupt global trade. We'll break down the implications for the commodities market. Half an hour into the start of the U.S. trading day, let's get a check on the markets brought to you by Tasty Trade. Taking a look at the major averages, we are seeing continued selling following the market open. You've got your S&P 500 down about 0.7%. Your tech-heavy NASDAQ down nearly 1.3%. We did see stocks recovering their multiple days of losses off of the close on Wednesday. But now this morning, you are seeing that continued move to the downside in stocks. But let's flip over to the bond market because we're interestingly seeing yields continuing to tick up even off of the back of that slightly better than expected inflation data, perhaps a sign that the bond market is more focused on the policy uncertainty coming out of Washington than the economic data. But let's look at our final risk on, risk off indicator here, Bitcoin. You've got Bitcoin down about 1%, hovering just below that 82,000 level today. For more on the outlook for markets following the sell-off in stocks that we've been seeing triggered by some of those recession fears and uncertainty around policy, we've got Mark Malik. He's the Chief Investment Officer at Siebert, an investment firm that's been a member of the NYSE since 1967 with $19 billion in assets under management. Mark, great to have you in the studio.
Great to be here.
Thank you for coming in. I was asking you, what have you done in response to the sell-off? And you said, not much, because your thesis is still there. How have you maintained that conviction given all the uncertainty?
Well, it's tough. We're looking more closely than we ever have at this point, and we're certainly adding factors that we hadn't traditionally looked at, right? So clearly we're looking more closely into supply chains and things like that. Of course, we always looked at that stuff, but it's more important at this point. So we open up our books and say, okay, we got to look very closely because there must be something to do here. And the theses, as you said, that we've had prior to this time of turbulence, they still hold. In fact, they're looking even better in a lot of cases because we've had some sell-offs in what I perceive to be things that have a lot of potential upside. Now there's just more upside. So it's tough to maintain that conviction sometimes, but if you look at the horizon, we see, significant potential upside, certainly in certain sectors.
And were you fully allocated into this sell-off, or did you have any cash available to deploy if there were any dip buying opportunities?
No, but we always have cash coming in, right? Mm-hmm. So when the cash comes in, we have to make those decisions. Do we hold off? Do we get in at this point? We were fully in. We expected to have a turbulent first half of the year, mm-hmm. Because of the market itself, right? But in terms of the money coming in, we were allocating it as it came in. So we viewed that as a dip buying opportunity.
And what did that dip buying look like? Were there any sectors that looked particularly attractive?
Yeah, I'm going to be very boring with you, right? We're looking at, I think someone said before that, the magnificent 5 or 6 or something like that. And you know what the 7th one is that we're not allocating into. But no, we see that there's plenty of upside still in the AI infrastructure, in the ecosystem. We believe that there's a lot of upside there. Obviously, there's a lot of adjusting happening at this point. It's a relatively new industry, but we're early in the game. And we try to invest for the longer term, which used to be 5 to 7 years. Now we're talking 18 months to 2 years. Yeah. But still, we believe that there's significant upside over the next midterm to the end of the year and beyond even.
But that's really interesting to me because I keep having these conversations with folks who are tepid about their conviction on big tech. And it's interesting to hear you say, no, we're actually buying into the big tech sell-off. Is that a lack of concern about that valuation question? Has that gone away following the sell-off? Or I guess, what is your biggest concern about those tech names?
I think that the biggest challenge in the tech names is not necessarily the rejiggering of valuations, right? We expect that. But we believe, again, that over the long term, the hardest part is going to be all of that rejiggering mm-hmm. and staying focused and having our clients remain focused and understanding. And you're seeing an evolution of the technology in a lot of cases. AI AI specifically, and you guys earlier spoke to quantum computing. I mean, this is unfolding as we speak, but the opportunity still remains big. The hardest part is staying in and understanding the technologies. I mean, not everyone's going to win at the end of the day, but there are some pretty clear winners, and if you scratch beneath the surface and you go down a few levels, you will see that there are clear paths for these companies.
And given what we saw with DeepSeek, do you think the U.S. maintains its dominance as the equity market that has the best exposure to AI plays, or do you think that opportunity might start to exist more in the likes of China?
No, we believe the U.S. is still the best place, right? We have the best technology here, and we have, the first mover advantage here. We believe that when you see these emerging technologies like DeepSeek and a lot of others that have bubbled out recently, it only makes the market stronger, right? So we bought into that, right? So when everyone panicked about the DeepSeek thing, we thought, wow, this is great for the market because now competition is increasing. And if you follow these companies that they're competing with, OpenAI, et cetera, you've seen a speed up of product release. So you've seen this actually forces them to do things that is very positive, I believe, for the market and the whole ecosystem. That includes servers and chips and security, cybersecurity companies. Everything that goes into building that infrastructure, I think, benefits from the competition. We
talked a lot of AI. I want to end on tariffs and just the policy uncertainty. How concerned are you about both the market selling off continuing and also any potential recession risk off the back of this lack of known about where we're going?
Yeah, well, you hit it right on the head, the lack of known, right? So the tariffs, if you look at the tariffs themselves, if these tariffs are in place and they stay in place, it's clearly not beneficial for the economy, not beneficial for companies, right? So somebody's going to pay for those tariffs, whether it's you and I at the cash register or the companies that we invest in. So it's going to be a bit of a drag on the economy if they're long-standing. We don't expect that they're going to be long-standing, although there's going to be a lot of turbulence at this point until we get there.
Even as Trump doubles down, you think?
It's very, very, that's the hardest part about this job right now, which is looking through it and trying to figure out, yes, the uncertainties are not very good, and they definitely test one's stomach. But in terms of, as I said earlier, we're looking at supply chains. So yeah, of course we are looking at, even if you look at, let's say, an auto company, right, they're, the types of components that go into these automobiles and where do they sell, right? So GM, they use all these products that are going to be tariffed. GM sells a lot of vehicles in China, surprisingly. So if there are any countermeasures, that could be a challenge for them. So we are looking at that. That is definitely a factor. But we believe that, again, that a lot of this will blow over and the market's going to sort of get used to whatever we end up with at some point. But again, we try to be more long-term oriented, and we, if anything, look at these market moves as potential buying opportunities. Certainly if we see value, right? Still has to be supported by the fundamentals. But beyond that, we feel like this is a time of turbulence that's going to pass.
All right, Mark, really great stuff for us to think about. Thank you so much for coming in. Really appreciate it. Well, some headlines crossing the wire from an interview with Treasury Secretary Scott Bessent on CNBC, saying a government shutdown would be incredibly disruptive. This comes after Senate Democratic leader Chuck Schumer said his party would block a Republican spending bill that could avert a government shutdown and urged the GOP to accept a Democratic plan to provide funding through April 11th instead. Here with the latest, we've got our very own Ben Werschel. Ben, obviously a lot of headlines to monitor here. I want to talk specifically about that government shutdown. Where are we at? What are you thinking in terms of the likelihood of this shutdown happening?
Yeah, so we've got two competing plans at the moment. We've got the GOP plan, which is a 99-page bill that would avert a government shutdown through the end of September. This is what passed the House earlier this week by basically party line margins, and the Senate is determined to vote on as soon as Friday. The Democrats have countered that the Republicans simply don't have the votes for that. In the Senate, you need 60 votes, and they've countered with a 1-month extension that would not have some spending cuts, which are in the GOP plan that are proving a little less popular, at least among Democrats. So those two plans are kind of coming to a head. The schedule at the moment is for a vote on Friday, but this could change at any time as negotiations continue. The bottom line here is that there's only one plan that can avert a government shutdown in time, it seems, which is the House plan that would avert it to September. So there's going to push through a vote there. The question is whether Democrats get an amendment vote on their 1-month plan and then accede to the overall plan, or how that plays out. But it's coming in the days ahead, and as the Treasury Secretary's quote alluded to, kind of a least ideal time for markets which are already unsettled, and this is sort of another note of an uncertainty for certain on this.
And Ben, another headline to bring you from Treasury Secretary Bessent's remarks. He is saying that when he talked about the government spending requiring a detox, that was not a euphemism for a recession. And I think that ties nicely into your latest article about Trump not caring necessarily less about markets. He just cares about tariffs more. What does that mean in terms of the outlook for markets and for the economy?
Yeah, it means that Trump and his team are much more willing to accept some short-term pain than I think markets were accepting. I tried to write about this yesterday because, as someone who tracked Trump pretty closely during the campaign, it's not super surprising considering he talked up tariffs as his number one priority every day, and that was continued there. But he has shown, in a contrast to his first administration, which I think markets were expecting more of, that he would sort of defer to the markets, he has sort of said, you know what, there's a whole list of different euphemisms they use: detox, little bit of disruption, transition period, all these things that kind of get to a core message here, which is that they're willing to deal with some problems in the short term because they think the long term that the economy will be stronger if tariffs are in place, and if tariffs are in place kind of at a high level for an extended period.
Yeah, certainly giving us plenty of headlines to monitor. Ben, thank you so much. As always, great to have you.
Sure thing.
Coming up, taking a look at some of today's trending tickers, what Dollar General earnings might show us about the state of the consumer. That's next. Now time for some of today's trending tickers. Scan the QR code on your screen to track the best and worst performing stocks of the session at Yahoo Finance's trending tickers page. First up, UiPath tumbling after issuing disappointing guidance for its current quarter and fiscal year. The automation software company citing global macro uncertainty, especially in the U.S. Revenue for the fourth quarter increased 5% from a year earlier, still coming in below estimates. The company also announcing the acquisition of Peak AI Limited, a company that focuses on accelerating AI adoption in other sectors, including retail and manufacturing. Shares are down 14%. Next up, Novo Nordisk getting an upgrade from Kepler, a longtime skeptic of the weight loss drug maker. Analyst David Evans raising the stock to buy from hold, saying his concerns around competition and pricing are now factored into the price, following its decline from last year's record high. You can see here shares are up about 3%. And finally, Dollar General topping fourth quarter revenue expectations, but missing on earnings, hit by charges for its store portfolio review. As a result of that review, the company does plan to close 96 DG stores and 45 Pop Shelf stores and convert an additional 6 Pop Shelf stores to Dollar General stores. Joining me now with more, Michael Lasser, UBS U.S. Hardline and Broadline and Food Retail Analyst. Great to have you on here. You've got Dollar General shares moving to the upside here. What do you make of the market reaction to the results?
What we make of the market reaction to the results is a couplefold. Number one, the company's showing some stability. It's been in the midst of a transformation for the last several years, and its fourth quarter results showed some progress. And that, I think, is encouraging to the market. The second point is that it set expectations for the year that are reasonable. There's a very uncertain backdrop for the consumer. The fact that Dollar General sells consistently purchased consumable items that are offered in convenient locations is an appealing model in this very uncertain time. So I think the market's reacting to those factors.
And what does the earnings result from Dollar General tell us about the health of the consumer? There were signs that low-income customers were still struggling. Are they targeting a higher-income consumer? And what does that indicate just about the health of this economy?
The core dollar store customer tends to be at the lower income demographic. With that being said, there have been signs that consumer cohort have been under pressure for a considerable amount of time. Don't think that's changed, whether it's inflationary pressure, other macro uncertainties that have weighed on that customer, as well as other demographics. What the results from the Dollar General showed this morning is that the consumer's gravitating to more needs related purchases and less wants related purchases. And that's really the key conclusion from the results today.
And how are you thinking about the potential for price increases at some of these stores off the back of President Trump's tariff policies impacting their sales and profit margins going forward?
Retailers are not in the business of absorbing excess costs. When they are faced with increased costs, their formula, their game plan is either to push back on vendors, reformulate the products to lower the cost basis, or pass along price increases. I believe we will see some of these tariffs that are passed along in the form of higher prices throughout retail. And as a result, the market is going to adjust, and the consumer is going to have to absorb at least a portion of this.
And I'm just curious how you are reading kind of the totality of retail earnings over the course of this quarter. You obviously had a lot of the big box retailers, your Walmarts, your Targets, issuing cautious forward guidance. What is that telling you just about the risks that are associated with the economy right now?
A couple of things. One, the consumer is being choiceful and episodic. The consumer came out, spent around the holidays. They had money to spend. That was encouraging. With that being said, the weather and other uncertainties weighed on some spending in February and March, and that shows we are in a very uncertain and volatile environment for the retail sector. The most likely case is that is going to continue for the foreseeable future until there's more clarity on some of these topics like tariffs, immigration policy enforcement, and others. And the consumer is going to adjust accordingly.
And I wonder, too, how you're thinking about consumer staples in general. Typically, we do see consumer staples as a beneficiary of any economic slowdown. What do you make of that basket of stocks?
So, we focus on the consumer staples retailers. And in this environment, their relative stability, their durability looks more appealing. A place like Dollar General that's generating low single-digit comps has a path to improvement. We think is attractive in this really volatile and uncertain environment.
All right, Michael, we got to leave it there. Thank you so much.
Thank you very much.
Really appreciate it. Coming up, we'll check in on commodities. Uncertainty around trade tensions continuing to weigh on oil, boosting the price of gold. We're going to discuss all those moves next.
Tesla shares have been cut in half from their December highs. Is it time to buy the dip, or does history suggest more weakness ahead? I'm Jared Blickery, host of Stocks in Translation. First, let's get to some definitions. One of the tools in technical analysis I like to find to help find the little dips here is RSI, or Relative Strength Index. This is a momentum indicator that measures how fast and how much a stock's price is changing, and it's scaled from 0 to 100. So at the 30 level and the 70 level, those are important thresholds. When it gets all the way up to 70 or above, that's when prices are rising too quickly, which sets up the potential for a stock to drop. When it's oversold, that's an RSI below 30. When price drops too quickly, that sets up the potential for stocks to rise. So having said that, let's look at a few charts here. This is what RSI looks like, and I know it looks like kind of a messy EEG here. This stretches back about 2 years or so, and we're looking at the bear market at the end of that, and also the bull market that ensued. And this is specifically Tesla stock. And you'll notice there, whenever it dips under this green line, which is 30, and rises back above, I put a vertical line here to signal that it has gone down, and now it has crossed out of oversold territory. Now, keeping that in mind, I have those same lines, the same levels on this chart here. So each of these vertical lines corresponds to a low in RSI when it is bottomed and then climb back over that 30 level. And you can see here, you can see a lot of these are catching interim bottoms. Not all of them. Sometimes there's false positives, but for the most part, these are catching some of the major bottoms in Tesla price. And I should mention here too, this is a counter trend strategy. So that means you're fighting the tide, and that means that there's more danger to these trades. Now, if you go back all the way in Tesla's history to the very beginning of its IPO, these are the results. If you had bought after the RSI bounces from that oversold condition over the following week, week, you would have a median return of 3.3%. And it is positive 66% of the time throughout history. We see similar results kind of for 2 weeks and 1 month, although it can go up and down a little bit. But these aren't spectacular numbers. For stocks which tend to go up, I want to see solidly above 70, ideally 80% in terms of the percent positive. We don't really get there until 1 year. Now, in setting up these trading systems, it's also very tempting to introduce more rules. And one of the rules that I attempted to incorporate was a filtering with the 5-day moving average. And that is, I wanted price to actually climb above that 5-day moving average in order to get one of these buy signals. There's always a trade-off here. And so we ended up with fewer trades and fewer false positives, but we also lowered some of the returns across some of these spectrums. So bottom line, it's probably a good time to buy Tesla right now, but you have to be nimble here. And this is more of a contrarian trade, so this is a trader's call as opposed to a long-term investment strategy. So tune in to Stocks in Translation for more market decoding deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance website or wherever you find your podcasts.
Jared, thanks so much. As always, appreciate you breaking that down for us. The International Energy Agency says that oil demand is weakening amid ongoing trade tensions and warning of a wider than anticipated supply surplus in the months ahead. That Thursday report coming as OPEC Plus output and tariff concerns pressure oil prices. You can see that action continuing. Brent currently trading just around $70 a barrel. Joining me now for more, Rob Thummel, Taurus Senior Portfolio Manager and MD. Thanks so much for being here, Rob. Just talk to me about how low you think the price of oil could go here. I am seeing some calls this morning as low as $50 a barrel. Do you think that's a possibility?
Yeah, we'll see. I think oil prices probably range in the $60 to $80 range. Obviously, they're headed toward, been headed towards 60, not towards 80, and probably the last month. They're actually really since the start of the year. So I think they could probably get down into the 60s. If they pop into the 50s, I think you're going to see producers in the U.S. start to pull back on drilling activity, and that will obviously lower the supply. The biggest probably upside potential, though, is, and I think it's something that nobody's not talking a lot about, is Iran, and sanctions on Iran will actually take supply off the global oil market. And so that could have an impact to push oil prices higher.
So how does that impact prices at the pump? This is something that Treasury Secretary Scott Bessent has talked about a lot, the desire for the Trump administration to keep those gas prices for consumers low. Do you anticipate that?
Yeah, I do think gasoline prices, have come down a reasonable amount, and I think they can continue to, and be at this low level. This is a really, $3 below $3, I think, is possible, and at the pump, and I think that's a good place to be for a lot of consumers around the U.S. because that will ultimately boost driving demand, and obviously, if driving demand goes up, then oil demand in the U.S. goes up as well.
Any risk of consumers seeing higher prices at the pump, oil getting more expensive for them?
Well, OPEC Plus has a lot of supply that's really curtailed right now that they could bring back to the market. And as I think you highlighted, they're going to bring back a little bit here starting in April, and then just gradually bring back some additional supply going forward. So if you're adding to the supply of the global oil market, that probably just helps keep prices lower and not cause them to go higher. So geopolitical risk premium has probably come out of the oil price right now. And that's probably one of the biggest things that would drive oil prices higher. But right now, there doesn't seem to be a lot of premium and built into the oil price.
So talk to me about any individual plays that you see in the space. I know Williams and Cheniere are some stocks that you're looking at.
Yeah, so at Tortoise, what we look at from an energy perspective, you look at the energy sector, we think the sector is really being redefined, and it's going to be less about oil in the future and more about natural gas. And so the future of energy is natural gas. Williams and Cheniere are great ways to look at the sector that way. Williams is one of the largest pipeline operators in the U.S. And one of the largest natural gas pipeline operators in the U.S. If you think about what natural gas demand is going to do, it's going to increase, we think, and increase pretty substantially for a long period of time. Part of the reason is because all these data centers need electricity, and they need reliable electricity, and natural gas supplies that. And so Williams actually is going to be actively involved in helping really build out this AI infrastructure. Cheniere is another option because Cheniere is the largest exporter of U.S. LNG. The U.S. is the largest LNG exporter, liquefied natural gas exporter in the world. And Cheniere is the largest liquefied natural gas or LNG exporter in the U.S. They've got a tremendous opportunity ahead of them. The company already generates a lot of free cash flow, and has high quality earnings that they pay out to shareholders, whether it's buybacks or dividend yields. And the growth in U.S. LNG demand is going to just be quite substantial. We think that LNG exports from the U.S. will almost double between now and 2030, and they probably go higher from there. So it's a great way to get into a stock that generates high quality earnings. Both of these stocks generate dividend yields, dividend growth, and buyback stock as well.
All right, Rob, thank you so much for joining us. Really appreciate it.
Thanks for having me.
Well, Macquarie analysts forecasting gold prices could hit $3,500 in the third quarter as safe haven demand continues to rise. Yahoo Finance's Inez Ferre is joining me here with more. Hey, Inez.
Hey, Madison. Yeah, and as we approach that $3,000 threshold, Wall Street is really starting to raise their price target for the precious metal. So the latest forecast comes from Macquarie Group predicting that gold will touch $3,500 during the third quarter of this year. And the analysts are predicting that the average for that quarter will be $3,150. Now, why? Because of President Trump's rapid tariff announcements. Those have contributed to geopolitical uncertainty, supporting higher gold prices. Now, the tariff policy, also a worsening picture for the U.S. budget, could mean higher inflation. And we saw yesterday that BNP also raised their price target, saying that they're expecting gold prices to push up above $3,100 during the second quarter as tariffs and geopolitical risks boost demand. However, the strategists over there are saying that in the second half of the year, they see gold struggling to go higher than that because of those trade geopolitical worries that are already priced in by then. So unless you have more escalation with those tariffs going into the second half of the year, they're saying that there could be a cap. It's worth noting that Goldman Sachs last month also increased their gold price target to $3,100 for this year. Right now, we are trading really near record highs. These are the gold futures. The spot gold is a little bit less than that, but the spot gold reached a record high back in February. So we're about $16 off of the spot gold price. But as far as the gold futures are concerned, you're looking at $29.64. And year to date, we're seeing it's up more than 11%, Madison.
All right, Inez, thanks so much as always. Appreciate it. Coming up, I will be sitting down with investor Kevin O'Leary to talk trade, tariffs, TikTok, and more. It's a conversation you won't want to miss. Stick around for that next on Catalysts. The tit for tat on tariffs continues. President Trump not backing down from his 25% tariffs on steel and aluminum, despite reciprocal tariffs from Canada and the EU. And the latest this morning, President Trump saying he will retaliate and threaten 200% tariffs on European alcohol. Here to discuss tariffs, the economy, markets, and more, I want to bring in Kevin O'Leary, O'Leary Ventures Chairman, to discuss. Kevin, always a pleasure to have you. Thanks for making time for us this morning. As you know, the markets just want clarity here on this tit for tat on tariffs. The tensions seem to be getting worse, not better. What does the off-ramp look like where we can start to see this wrapping up so that the market can just have some clarity, even if it's bad news?
The off-ramp starts on April 2nd when the tariff schedules for all countries, Canada, Mexico, European countries included, are actually detailed in the sense that, remember, think about this. Tariffs, particularly European and some Canadian tariffs, were put on after Second World War, and they have never been examined or even discussed in many negotiations over the past decades. So let me give you an example. It's very simple to understand. Vermont produces dairy products. They're tariffed at 243% going into the province of Quebec, Canada. Mm-hmm. A reciprocal response would be to do the same to any dairy products coming out of Quebec into the United States. And that's exactly what's going to happen on April 2nd. And it'll be the same for India, agricultural products in England, the same for Mexican products. And so what we're doing here is we're getting a big reset. Trump has made it very clear from 30,000 feet that he wants to reset all the tariff schedules from as far back as the Second World War and just have reciprocal tariffs. Now, the thing about tariffs is you have to think of them as negotiating tools of economic warfare. That's the way I look at it. So back to the dairy example. After a while, both sides look at each other and say, well, we're both tariffing each other at 243%. There's really no economic gain. This is kind of stupid because we don't have access to each other's markets, particularly if you're in Quebec and you want to sell to Texas.
Yeah.
Why don't we just forget about tariffing dairy and we'll just open it up to free trade? And then you look at the same thing with aluminum, where the U.S. says, well, gee, we've only got 2 smelting plants and we need more aluminum. For the 15 years it's going to take to build new plants, we'll just drop the tariffs on aluminum. How about potash with Saskatchewan? There is no potash in the U.S., but farmers need it. Why tariff that at 25%?
So, Kevin, how quickly do we get there? Do we get to this euphoric era that you're talking about here of free trade? Because it sounds like something that takes a long time, and the market is selling off now.
Yeah, it's already sold off. You've got your 10% correction, but the economy is quite strong, so is the consumer. So in the case of Canada, nothing's going to happen for at least 90 days because there's no prime minister there. There's an interim one, and we need an election in Canada. Then we'll be dealing with somebody with a 4-year mandate. In the case of Europe, they've already started, the British particularly, on the agriculture. Ireland yesterday. So these things take, months. But the market's not stupid. I mean, you have to decide now if you're an investor. Are these tariffs going to be the McKinley-type tariffs which stay on for 20 years? Or is this a negotiating tactic to have reciprocal arrangements around the world with the United States? I'm in the camp that says Trump doesn't want to trash the market indefinitely. Mm-hmm. What he wants to do is use his first 24 months, his majority mandate before the midterms, to drive home a flat reciprocal environment for trade worldwide. And then he comes into the midterms with that achieved, because you can achieve that in 2 years. And that supports his party maintaining a slight majority, which I think is a good strategy. And yes, there's volatility. Nobody likes it. Nobody likes volatility. But the market's was extremely expensive. And frankly, for many of us, I've lived through multiple corrections up to 20%. I have to admit, I did some buying lately, and I can't catch the bottom. But I'm seeing great companies that still have great growth prospects selling down. You talk about the big 7. The average company in NASDAQ's down 30 to 40%.
Right.
And so there's lots of, and Russell 2000, it's fraught with value all over the place.
So then what are you buying, Kevin? What are you buying right now?
Well, I buy indices. And so, look, I'm just being transparent. I like to find indices that are rules-based. I use ALPS because I once had a ETF company that did this, and I use their OUSA product for the S&P 500 and OUSM for the Russell 2000. And I bought more because it's on sale. And everybody feels, oh my goodness, it's the end of the free world as we know it. This always happens. Nobody likes volatility. But as an investor, you learn that you have to hold your nose. And when there's blood in the streets, you have to be buying. It's an old adage, but it's not incorrect. You just have to look long term and realize these are buying opportunities, but never think you're going to catch the bottom. I don't even guess to do that. I don't try and time the market.
So, Kevin, I'm fascinated by this. It sounds like you are buying the dip on small caps, even though the Federal Reserve may have to keep interest rates higher for longer off the back of the inflation that these tariff policies are going to cause.
Well, inflation data yesterday was flat. I don't think there'll be 2 cuts this year. That's my assumption. So I kind of think everybody should chillax. Looking for Fed support. This idea of 3 cuts, forget it. I mean, their mandate's 2%. We're sitting at 3. So it's 33% higher than it has to be. And we got to wait. I mean, look, we put $2 trillion of free cash into the market in the last mandate, the last president. And I understand he had to deal with COVID, but now this money's sloshing around, keeping all kinds of stuff inflated, including housing and proteins and energy.
But you are an executive yourself, Kevin. You're not just an investor. And corporate America is begging this administration for clarity on these tariff policies because right now they're in this unknown and they're having to pause on hiring, pause on CapEx. Also, we're seeing small business confidence falling off a cliff. Doesn't that give you a concern that we might be heading toward a recession? No, I don't see the recession. I get the tear sheets from my own 54 private companies in all 11 sectors every Tuesday. I don't see it yet. Consumers still strong. Look, I'm not saying we won't have one, but I don't see it yet. And I think the effects of tariffs will be short-lived.
and I'm in the camp that says they're just being used as negotiating tools. No, I don't see the recession. If we had really, really, really difficult times with interest rates, maybe. But right now, see, for me, I have to do CapEx every quarter in the terms of inventory. So if I thought there was a recession, I would pull my horns in, spend less cash. But then I'd miss the opportunity of sales, which are remaining buoyant. And every retailer has the same problem. Every business has the same problem. And I think, yes, they like to jawbone uncertainty because of volatility on trade policy, but that's not actually what they're doing with their capital yet. You can keep talking about it and jawboning it, but you have to make a decision every single day. And we're not in recession decision-making mode yet.
So you're not pulling back on CapEx at all in your businesses?
No, not. And I'm 4 or 5 months ahead, so I'm worried about holiday for this coming year. So I have to build inventory, put it on the water, to sell in September for holiday. And I talk to my CEOs every day. We talk about this every single day.
And they're not asking you about this administration and the lack of, every CEO I have talked to has said they want clarity. I find it hard to believe that none of your CEOs have said they want that clarity.
Well, remember, 62% of job creation in America is companies 5 to 500 employees.
Right, and small business confidence is falling off a cliff.
Yeah, but you're talking mostly about indexing this S&P 500, which only creates 38% of jobs, and half of them are overseas. So I actually listen to the people that are the American economy.
But I am talking about small business owners who are saying that they are pausing on hiring, who make up, to your point, 80% of hiring in this country because they're concerned about tariff policy.
Well, I'm not seeing that. We're still hiring. Look, you can say one thing to someone who's doing market research, and then you have to turn around and deal with your business. You're asking me, do I see a recession? I'm telling you, no, not yet. We may talk again in 30 days and I may have a different answer. But right now, as I go through the tear sheets of last Tuesday, I don't see it. And that was in the middle of the craziness in the White House about tariffs. So yes, you can have, when the market declines 10%, people get nervous. That's volatility. But it doesn't necessarily change their day-to-day decision on CapEx, which drives job creation and growth. Because the consumer, yes, we're talking because you're Yahoo Finance. The average guy on the street is not as myopically focused on the Dow and the NASDAQ as we are.
Right, but they may be focused on the slowdown in hiring, but I'm going to let it go. I really want to get your thoughts on Canada before we let you go. Obviously, Prime Minister-elect Mark Carney is saying he is ready to talk to the president as long as Trump is willing to recognize Canadian sovereignty. Do you want Canada to be the 51st state? How are you reacting to the pushback from Canadian citizens as well?
Yeah, I don't think Canada's for sale. I think the Canadians have made that very clear. But the opportunity of an economic union is huge. Unfortunately for Carney, he's not going to be the one to negotiate it. Unlikely. He'll probably lose in the general election in the next 90 days to a man named Pierre Poilievre, who's leading in the polls.
But haven't Canadian citizens pushed back against him as the Canadian MAGA, given the tariff policy and the pushback from Canadians on tariffs?
That is one narrative, but when you actually look at the challenges, most people realize Carney is just Trudeau 2.0, and Trudeau was a disaster. His policies took the Canadian dollar from parity with U.S. down 41% and put basically 25% of the Canadian population into poverty. So it's not hard for the opposition, in this case the Conservatives, to paint the Trudeau 2.0 brush on Carney, because Carney has the same policies. He wants to double down on carbon tax on businesses, the same green agenda, massive wokeness, elitism. He's got all these problems that he's a Davos guy. And most Canadians don't know him because he didn't really live in Canada. He worked at the Bank of England for a majority of his period in recent times. And so he's got his uphill battle too. I doubt that it's not really, yesterday in an interview, Howard Lutnick said, look, we know that we can't negotiate a pan-Canadian deal. We're going to get Ford, this Premier of Ontario, to lower the rhetoric, invite him to the White House. He's there this morning. But a pan-Canadian deal needs a new prime minister. And there's no point in negotiating an interim guy for either side. They want to get the decision made. Right. And so basically, call it NAFTA 3, won't be negotiated until after the Canadian election. And it's important because frankly, the opportunity, and Trump sees this, you got to differentiate the noise from the signal with Trump. He sees, when he keeps saying, I want to buy Canada, there's a reason. The U.S. is the largest consumer market on earth, and Canada is the richest country on earth on natural resources that are proven.
Yeah.
You want to combine those economies, you create a behemoth China will never catch up to. You don't have to buy the country to do it. You just have to negotiate a deal where the economies are combined, maybe a common currency, maybe a EU-type passport, and certainly no tariffs.
So, Kevin, I want to pivot to TikTok before we let you go. The information out with a story this morning reporting that Larry Ellison's Oracle is the leading contender to help run TikTok in a new deal. Obviously, you have joined with Frank McCourt's People's Bid for months now that now has Alexis Ohanian involved as well. What do you make of this reporting that Oracle is the leading contender to buy TikTok?
Well, every day there's another TikTok rumor. 2 days ago, it was 4 bidders are bidding for TikTok. I know of no others, so I don't know them if they exist. It doesn't matter what I want or what Larry wants, or in my case, Frank and I look at this every day. What matters now is a narrative between Xi and Trump. The question is, does Xi want to sell TikTok, yes or no? In the case of India, he elected no, and they shut it down in 2000. So whoever is interested in TikTok, and certainly we got to wait to decide, is Xi going to sell it? Because he just may decide to turn it off because he doesn't want to sell the algorithm or have any exposure of the Chinese technology to the American buyer. And remember, we have to deal with a law here. There's a law that's been passed and a 9-0 decision from the Supreme Court that wants to stop any data from any social media platform from going to a foreign adversary, in this case, China. Yeah. So who's ever buying it has to comply with that law as well, and that's a complex situation. So I don't think the story is known yet, and I don't think one scenario that could happen would be that it goes dark on midnight on April 5, and then negotiations begin to see if it can be lit up again. Yeah. Meanwhile, it'll bleed users to other platforms. Right now, the leading contender would be Reels at Instagram.
Right. And
they're benefiting immensely now. Creators who make their living, 7 million businesses, and they all know who I am. They're all the Shark Tank generation. We talk every day about what's plan B if there is no TikTok. Where do we move? Right. Which is basically 50% of our digital spend right now. My company's put 50% of their digital customer acquisition costs on TikTok as it works. Right. We'll have to move.
All right, Kevin, great breakdown. Thank you so much for making time for us. We love getting your insights. Thank you for making the time.
Take care. Thank you.
We'll have all your markets action ahead here on Yahoo Finance. Stick around for more. European stocks mostly lower after President Donald Trump threatened 200% tariffs on European wine, champagne, and other alcohol, reacting to the EU hitting the U.S. with a 50% tariff on whiskey. We're just seeing the beginnings of the potential tit for tat between the U.S. and Europe, so what kind of risk could that be to the outperformance we've seen in Euro stocks? Here we got Brent Schutte, the Chief Investment Officer at Northwestern Mutual Wealth Management. Brent, great to have you on here. Okay, so this tit for tat that we are continuing to see develop between the EU and the U.S., how does that play into or potentially provide a headwind for the U.S. exceptionalism dead narrative and the drive forward in EU stocks?
I mean, so there's been quite a bit of commentary about U.S. exceptionalism, and certainly people have invested in that way. And so the one thing I think you need to add to your conversation is valuation and where some of these stocks are at. Certainly within the U.S., the market has been bid up, especially the S&P, which is historically expensive. Europe has been cheap, and it's been cheap for a reason. Oftentimes, cheap companies, cheap countries need a catalyst. And to me, that's where there's some important movement recently, whereas now the Eurozone and Europe has figured out they have to spend on their own defense. They may actually have to spend to stimulate their economies. And that's where I think you could actually see this Eurozone outperformance continue into the future, even with the tariffs that are potentially out there in the future, which could be on, could be off. And I bring it back to valuation as kind of the ultimate decision point. That's where I think there is opportunities pushing forward, especially if some of those catalysts come to fruition.
How much opportunity is there in China then?
To me, there's probably less. I mean, Chinese economy has certainly its own problems. I do think there are valuation story there also. But to me, that is more of a longer term story of China's decline based upon, just population declines. Certainly, we don't want to ignore China, but we certainly have less of that in our portfolios than we do of, say, for example, the Eurozone.
And what are you anticipating comes next for the U.S. stock market, given the selling we've seen?
Look, I think we still have probably some, unfortunately, selling to go. There are still quite a few dip buyers out there that are buying double long, triple long things on single stocks and on technology stocks. They've been adding to those positions recently, and that's an area of the market that I would think we would have to probably wash some of that speculation out longer term to create a more sustainable bottom. That does not mean that you go out and sell tomorrow. No one knows when the bottom's going to happen. It's just that there's more volatility ahead, and I want people to stay invested through that. And I want people to think about things on the other side. So my catalyst and valuation comments don't just apply to Europe. They also apply to U.S. small, U.S. mid, and quite frankly, a lot of other sectors and segments outside of technology.
All right, Brent, really great breakdown. We'll have to bring you back to talk more in depth soon. Appreciate your time this morning. Thank you.
Thank you.
Coming up, we've got Wealth that's dedicated to all of your personal finance needs. Our very own Brad Smith. He'll have you here for the next hour, so stay tuned for that and more.